The Reserve Bank of India kept the repo rate unchanged at 5.15%, contrary to many expectations of a rate cut.
The Monetary Policy Committee had discussions during 3rd, 4th and 5th December. It deliberated extensively on the current and evolving macroeconomic and financial conditions and the outlook. Based on its considered assessment, the MPC voted unanimously to keep the policy rate unchanged. It, however, decided to continue with the accommodative stance as long as it is necessary to revive growth while ensuring that inflation remains within the target.
Hi, this is Ankit Saproo from ET Online, and we'll look at the reasons why the RBI decided not to go for a rate cut. The decision taken by the Monetary Policy Committee of not going for a rate cut came in the light of the CPI inflation for the month of October breaching the medium-term target of the RBI of 4% and climbing to 4.6%, mainly driven by a rise in food prices and onion prices in particular. And even the RBI commentary has taken note of that. RBI has also revised upwards its inflation projection for the second half, which basically means that the RBI sees the prices hardening in the months to come before the second quarter of the next fiscal, in which the Reserve Bank of India sees the inflation target below its medium-term target of 4%. Another reason is that the RBI has decided to take a wait-and-watch stance. It is basically waiting for the government to probably to announce some more counter-cyclical measures in the upcoming budget, which will be announced in February before the RBI's next monetary policy review. The Reserve Bank of India also took into consideration the fact that the government has already announced steps to pump prime the economy, and also it has decided to wait and watch the effect of the successive rate cuts, the 5 rate cuts which the RBI has announced so far, amounting to 135 basis points for them to basically optimize and show effect on the economy. The Reserve Bank of India also noted the external considerations, the global sentiments which have been hurt because of an ongoing trade war between the United States and China. The global oil prices have moved in a narrow range and they have mostly remained benign. But any geopolitical shock or the trade talks not yielding any positive result could impact the global oil prices, which could hurt the domestic prices, thereby impacting the further chances of a rate cut. The Monetary Policy Committee deliberations happened in the light of the second quarter GDP growth falling to 4.5% from 5% in the first quarter. The RBI sees that the steps taken by the government, like cutting the corporate tax, will improve the capex cycle. It will revive investments by the corporates in the economy. It also sees that the monetary transmission will improve on the back of the external benchmarking by the RBI, and thereby it will aid the overall economic growth in the economy. The Monetary Policy Committee has kept the stance accommodative, thereby leaving the room for another possible rate cut in its next policy review in February.